Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hi, everybody. I'm Don McDonald. You know how you meant to get down to or get around to working on your financials, to looking at your financial situation, trying to put together a budget, trying to figure out what your cost of living is so that you can retire in the future and you have an idea what that's going to be. You wanted to kind of begin to create a plan about the life you want to live and how you're going to fund it and how much it's going to take. What a good time to do that. But, do something like that. Or give me a call at 855-935-TALK, 855-935-8255. There's nothing like some good, old-fashioned, honest, straightforward money talk to make you forget about your troubles and make you look forward to your future. So give me a call, 855-935-TALK, 855-935-8255. I'm going to, if you call the show and ask a question this week, we're going to make sure you get a free copy of my book, Financial Physics, the 2018 edition, the latest edition, absolutely free if you call in. And we don't make you pay shipping and handling or any of that. We just ship it to you at 855-935-TALK. So give me a call. We can talk about all kinds of things. I am so excited. This is how geeky I am about this stuff. Every 6 months, I look forward to the new SPIVA Mutual Fund Scorecard, SPIVA. It stands for Standard & Poor's Index versus Active Survey. They go out and look at how mutual funds, actively managed mutual funds, did compared to, of course, Standard & Poor's 500 indexes. It's a great way for them to get the Standard & Poor's name out there a lot. See, I keep saying it. And they compare to their indexes, which are like the S&P 500 and the S&P mid cap and small cap and growth and value and all of these different indexes they have. So they compare all of these different styles of mutual fund, the actively managed, to just owning the index itself. And once again, I know this is going to come as a huge surprise for most of you. Once again, the actively managed mutual funds are walloped. They're just destroyed by the indexes, by and large. If there were really talented mutual fund managers out there, you would expect to see a large percentage of them beating the index. But it's the other way around. It's exactly the opposite of what you'd expect if people on Wall Street had prognosticative talent, which they claim to have. You know they do. You see the ads for these systems and these smart mutual funds that are able to beat the market or Value Line or whomever it might be. Oh, we've got the way, AAII with their we can beat the stock market. No, you can't. If the actively managed mutual funds with trillions of dollars in them can't manage to do it, why would some joker with a newsletter be able to? This is just simple common sense, which is not so common. Common sense is extraordinarily uncommon. But I want you to try and use it from time to time. We're going to talk about some of these numbers. And also this year, Standard & Poor's did something a little different. They compared the performance before and after fees. And boy, do fees make a difference. 855-935-TALK is the number. Stop by.
Tom and Don are talking real money.
Do you need a little help with your investments? Set up a free, no-obligation appointment with one of our advisors at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Great day to call, 855-935-TALK, 855-935-8255. Stay warm, stay dry, stay out of an accident, and stay better informed about money, and enjoy a better retirement, and don't get ripped off. Oh, my gosh. You know, I get these calls from people all the time who got into something, and then they call me like a few days after they got into it, and they said, was that a good idea? And I go, no. We get a lot of those. I want to help you. I want to help you whenever, but I'd rather do it before you get into trouble. Get a ton of them. By the way, you can listen to a lot. We get calls 24 hours a day, 7 days a week on the hotline on that 855-935-TALK number. That's good anytime. And if you haven't yet, go check out the new daily podcasts that I put together every day. They run between about 10 and maybe 18 minutes. And in every one, I either answer a question that people send in or call in. And there's some good stuff there. So if you don't get enough Talking Real Money on the weekend, you can get it all the time on your favorite podcast service or at TalkingRealMoney.com. Our number again, 855-935-TALK is the number, and we'll send you a copy of the only book that really talks about money and investing in a realistic way. The truth about how money and investing really work. It's called Financial Physics. I wrote it about 9 years ago, but I rewrote a copy last year, and you can get one free if you call in with a question, 855-935-TALK. Before the break, I was talking a little bit about the SPIVA, S-P-I-V-A, Standard & Poor's Index versus Active Scorecard or survey that they do every 6 months on mutual funds to see how they compare to the Standard & Poor's indexes. Of course, they don't compare them to the really broad indexes, but this is good enough. I love seeing this because it reinforces my, I don't even think it's a belief anymore. We almost have to state this is a fact. I think the game is up. The jig is up, people. Actively managed mutual funds will not beat indexes. As a matter of fact, mathematically, they can't. In aggregate, actively managed mutual funds cannot beat the market. It's impossible. Now, some can. But, you would almost expect if some beat the market and some don't beat the market, that if it was just luck, you'd almost have 50% beating the market and 50% not beating the market, right? If that was just luck, you would think that. And then you add fees in, and of course that makes the active fund managers look even worse. It makes them look worse. But it's interesting. This year, S&P compared the actively managed mutual funds performance against the index before fees to see if they could come a little closer just due to dumb luck. And even that didn't work. For example, if we look at the entire universe of domestic U.S. equity funds compared to the S&P Composite 1500, gross of fees, before fees, less than 24% beat the index. What tells you a lot about the negative impact of higher fees is that after fees, 13%, a little over 13%, beat the index. So that means almost 87% of funds after fees and expenses could not beat just paying a little bit of nothing and buying the index, buying passive. The only category on this list where active fund managers came close to what you'd expect from just dumb luck is in the value category, where the S&P 500 value fund is compared with the large cap value actively managed funds. And in that case, 50.74% underperformed. So 49.26%. actually outperformed the S&P 500, but that was before fees. After fees, that number drops to below 30% that beat the market. And in some categories, the after-fee performance was deplorable. And again, you have to figure some people are going to get lucky. For example, in mid-cap funds. In mid-cap funds, just over 2%. Oh, and by the way, this is over 10 years. This isn't 1 year. This is a really long period. This is 10 years. In this one area, just over 2% beat the market in the total mid-cap or mid-cap growth area. In just all the mid-caps, a little over 3% beat the index. That is really sad. Internationally, global funds, 82% failed to beat the market. 82%. So 18%, only 18% beat the market. About the same number internationally. And it's pretty much the same across the board. The only area where some active managers tended to outperform the indexes were in some bond categories. And again, it wasn't dramatic. It wasn't substantial. After fees. It's the fees that killed them. For example, I'll give you a weird example. The California bond funds, California municipal bond funds, the managers outperformed the index almost 75% of the time before fees. After they charged the fees, less than a third. So they were very successful before fees, but because they charge so much to do what they do, you're better off with the index again. And it's across the board. There was one category where it was hysterical. Global junk bonds. Global junk bond actively managed mutual funds. Never, not one actively managed global high yield a.k.a. junk bond fund, not one, beat the Barclays Global High Yield Index. Not one. Oh, wait, before expenses, yeah, a few, like 18%, 19%. But after expenses, because they charge so much, none. Zero. Why? Why are brokers continuing to sell actively managed mutual funds? I'd love for a stockbroker to come on here and tell me why. I've asked before. I haven't had a single one who was able to explain to me why they sell their clients actively managed mutual funds. I mean, I guess I can, because they want to make themselves look smart, because they're smart, then they can pick the smart managers, but the reality is none of them can. None of them can. The odds of you finding funds that beat the market consistently, close to zero.
Tom and Don are talking real money.
Tom and I believe in helping everybody become a better investor. That's why we offer lots of free knowledge at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
I'm Don. Let's go to the phones. Tom, welcome to the show. You don't get a book.
Doggone it, I was hoping, because my reading skills have improved greatly with all this sitting around waiting for the snow to melt.
Is it gonna?
Well, yes. It's like the market going down. It will happen. It's just a matter of when.
Fire up the pizza oven and melt the darn stuff.
I just wanted to add on to your you're doing a great job, by the way. I just wanted to add on to your discussion about active versus passive. Active, which some people may not know, of course, is people picking stocks, timing markets, being in certain sectors, seeing trends, trying to take advantage of all that. I think it's more fascinating beyond the mutual fund aspect, which is incredible in and of itself. But then you throw the hedge funds in. We learned this week that Ray Dalio has been one of the heroes of the hedge fund industry. just got fired by a very small municipality because he's underperformed for the last 10 years. Hedge funds spend, more money on all this. They got the experts. They got the PhDs. They can use leverage. They have all the tricks, and they can't beat the market. I mean, so if it's not enough for the mutual funds to convince you, I think hedge funds are another area where you should say, you know what, I'll just accept market returns. That'll be good enough for me.
Interesting you should mention hedge funds. I was doing some research for a future podcast over the week and was looking at Jim Cramer's relatively well-known claim that when he was he had a very small hedge fund. When he was a small hedge fund manager, he made 24% on average every year after expenses, after his cut. And I've always been astonished at that number. So I was doing a little research, and I came upon some old videos of Mr. Cramer being interviewed about his success in his hedge funds. And it turns out because his hedge funds were so small, he outright comes out and says it. He manipulated the markets. So they're not.
Well, and in particular stocks too, of course, correct, right? I mean, in particular areas where there may have been an inefficiency that he could take advantage of.
What he would do is he would buy and sell to make futures contracts move, and then he'd buy or sell back after he got out of a big futures position. He knew how to manipulate the market. It wasn't illegal, but it's manipulation. It's not smart. It's tricky. It's sneaky. It's low down, underhanded kind of stuff. And that's why I just don't see any reason to go anywhere near these things, because either they're lying, they're cheating, or they're just lucky.
Well, and here's the other part. Of course, now the big argument is, and I love this one, hey, what if everybody indexes? They're going to ruin the economy. They're going to ruin all these companies. There's not going to be any, corporate governance oversight, which is a complete silly notion. But they're using that now as another way to sort of knock down the, why you shouldn't own index funds. I think it's absolutely silly. I want to say thank you for doing a great job. I also want to dispel the rumor that I couldn't get up the hill. The reality is it's my daughter's birthday today. She's turning 11 years old, and I just had to stay here because you know how much I love a good party.
Right, particularly a party for an 11-year-old. There's nothing like those.
Those are really hard to miss. So, Aria, happy birthday. She's getting ready to start running the company here in the next couple of years. So
you called to sneak the happy birthday on the air, didn't you?
Indeed, I did. So be well, sir.
Indeed, he did. 855-935-TALK is our phone number, 855-935-8255.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
I want to talk more about hedge funds in a minute, but I want to go to the phones right now. Lloyd, welcome to Talking Real Money.
Thank you. A lot of talk about index funds. There's the S&P 500, the Russell 2000. What's the difference?
Oh, it's which stocks are included. For example, the S&P 500 is big blue chips. The Russell 2000 is smaller companies. So each index is slightly different. And then the S&P does have a new index called the Total Market Index that includes all of the U.S. stocks. And then there is a all-country world index by MCSI that includes all of the stocks in the entire world, publicly traded.
So the S&P 500 you've just described, there's two of those at least. Which one is the index fund that people refer to?
Well, okay, the S&P 500 is the actual index of the 500 largest U.S. companies based on the size of their market capitalization, based on their value in the stock market. The index will emulate that, or the index funds will emulate that. For example, at Vanguard, it's the Vanguard 500 index that emulates the S&P 500.
Okay.
That makes sense?
Do you have any comparison of the performance of the S&P 500 index versus the Russell 2000?
Well, it's not fair to compare those because they have totally different kinds of stocks. The Russell 2000 has, over a long period of time, made investors far more money, but with far greater risk. The S&P 500, being a large blue chip index, isn't as risky. They're more stable companies, so the returns have been a little lower. The segments of the market that have had the highest returns historically, based on tons of research, are small cap and value stocks, and the area that has had the greatest return are small cap value stocks, undervalued small companies. But those have high returns because their risk is proportionately higher. They can be very, very frightening. Whereas the S&P 500's worst year has been a loss of about 50%. Those indexes can go down 80%.
Well, thank you. You've helped me understand much better.
I am glad to do it, and give me a call anytime, and we'll get your number, and we'll send you out a book. Thanks for the call, 855-935-TALK. That's the number, 855-935-8255. There's always somebody out there trying to beat the market, and as Tom mentioned, you've got all these hedge funds, and these hedge funds charge outrageous amounts of money to supposedly give you good returns when the market goes up, and the reason for the term hedge is to protect you when the market goes down. But the reality, the rhetoric is one thing. Oh, you'd think that they're all brilliant and make a lot of money. You know, you can watch Billions and you go, whoa, look at these guys. They're making these people a lot of money. All the big high flyers are playing with these guys with like Axe Capital, which is loosely based on a company by Steve Cohen, SAC Capital, that actually is a hedge. This is a hedge fund that actually pleaded guilty to insider trading. The hedge fund pleaded guilty to a crime. The fund did, and had to pay huge fines, kind of like in Billions. But how do they actually perform? Well, we want to talk about that in a minute. 855-935-TALK is the number, 855-935-8255. Give me a call with a question and get a free copy of Financial Physics Month.
Tom and Don are talking real money.
Would you like to talk to a real investment advisor for free? Set up an appointment at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
That number again to call the show, to ask a question, to share your ideas, to comment on something is 855-935-8255, 855-935-TALK. Do you know that there are almost 50 billionaires from hedge funds, people who managed hedge funds who became billionaires? Billionaires. These people are becoming filthy rich, so they must be making their clients rich, right? Well, there is a hedge fund index by HFRX, and if you look back, now remember, they're supposed to do okay in bad markets, protect you, and then make you money in up markets, right? Well, from January 1st, 2008, January 1st, 2008 through December 31st, 2017, that's a 10-year period that includes one of the worst markets in history for stocks. The HFRX Global Hedge Fund Index lost an average of lost over that entire period 0.4%, made no money. Over that entire period, the total return of the S&P 500, which lost a fortune in 2008, just buying the index, you could have lost 0.4% over the 10 years, or you could have made 126% with just the S&P 500 over that 10-year period. Do you think those people earned their billions? You know the answer. 855-935-TALK is our number, and now it's Ted's turn on Talking Real Money. That's alliterative. Hi, Ted.
Hello. I have a question about minimum distributions from my IRAs. How do they calculate if I take out some this year or I don't take out some, but I pay the taxes on it anyway? Do I get continually taxed over again? I don't understand how they decide how much the minimum distribution has to be, and if I don't take it, is it set aside by the broker into an account that already has been taxed?
Well, you can take it and put it anywhere, but you must take it. You do not have a choice.
I've just let it roll over.
Okay, well that's fine, but you get taxed on the withdrawal. How old are you, Ted?
80.
Okay, so you've started taking them a long time ago. When you started, it was approximately 1/28th of the amount in your retirement accounts. As you get older, that factor becomes smaller until it gets down to, I think it's like 2%, or a factor of 2, not 2%. So that's been being taken, and you have been receiving statements showing the tax owed. Whether you've been paying it or not is another matter. Have you been paying the tax? You've been paying the tax, right?
Absolutely.
Then you're fine. Is your broker calculating it for you?
If I take out, say, $25,000 a year, which is about the required.
That would go toward your RMD. If it's more than your RMD, you would not be required to take out any more. If it's less than your RMD, for example, let's say your RMD next year is $26,000 and you take out 25, you'd have to take out an additional 1,000. But if your RMD next year is 24 and you take out 25, you're covered.
Okay.
And it will change the amount for the next year. You see, what they do then for the next year is they take what's left and they apply that factor.
But it's been going up every year.
Right. Your account can go up. The factor stays the same.
Okay.
But bear in mind, as you get older, that factor becomes a smaller and smaller number, which means the distributions get bigger and bigger.
Okay. So I'm okay if I just leave it the way it is.
You're doing just exactly what you need to do, even though the account is growing. That's absolutely fine. It's totally allowed. But just bear in mind, in like, let's see, when you're 97, approximately, I think it's 97, your factor's just going to be 2. So you're going to be taking out a big chunk, like half of your IRA.
I don't expect to live that long.
Well, try for us.
Okay.
Okay.
Thank you.
You're very welcome. Thanks for the call. 855-935-TALK is the number. 855-935-8255. Bob, your turn. Welcome to the show.
Hey, thank you for taking my call.
My pleasure.
So it's a question about MEBT. You know what that is?
MEBT?
Municipal Employee Benefit Trust.
Oh, okay. Yes.
So when you separate
Municipal Employees Benefits Trust. Yeah. Now I remember what it is.
So when you leave service with these different agencies, okay, you have to take it out, okay? Is there a way to convert it into an IRA?
I think that's is that a 457? I'm going to have to check. Hang on. Let me just make sure. I don't, for some reason, way in the back of my head, I haven't had a call on this in years, but for some reason.
Well, I'm referring people to you because of your retirement meet, so you're going to get more of these.
I guess we are. Hold on just a minute. I'm pretty sure not. Again, that's just in the back of my head somewhere. I'm not 100%. It's not something I have personally run into in a very long time. But I'm just trying to pull the rules up, and I'm right there. I'm right at it. It's just not coming up. I think it's cold. Yeah, you can't roll it over.
You can't the stuff that they've taken out instead of the Social Security. You can't roll it into a IRA.
Correct. That is absolutely correct.
So what do? Pay tax on the entire thing when you leave? because you have to take it out when you leave.
Well, no, you can annuitize it. It says you can annuitize it here. Money moved. I'm just trying to read all this stuff. Are you in Bellevue?
No, Mount Lake Terrace.
No, Mount Lake Terrace. Okay. Yeah,
But Bellevue has the same program.
Yeah, I was just looking at the Bellevue plan. That's what I was wondering. 401k. Boy, I'll tell you what, let me do some more research, and I'll comment on it a little later. I don't want to get this wrong, but for some reason, I think you can't. I want to double check, and I'll tell you in the next hour what you need to do on the air.
Okay.
Keep listening. Okay?
Okay.
Anything else? Because we're running. We got about a minute left.
Okay. So, I guess I'll talk to you later then. Okay.
Okay. I'll mention it on the air. Just keep listening to the radio. Thanks so much for calling. The number again is 855-935-TALK, 855-935-8255. And it's really easy to call the show. And one of the best things about calling today is you're going to get a copy of Financial Physics, my book, that doesn't have anything on MEBT because that doesn't come up very often. Because it's a Washington State deal. But let's see. It's a 401A. Okay, I knew it was something weird. Okay, I've got the rules here in front of me. I'm going to read through them during the breaks, and I'll get back with you guys in just a couple of minutes, okay? Again, the number 855-935-TALK. Get a copy of Financial Physics when you call with a question, and we'll return momentarily.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Really fast reader, and that's a good thing. You can leave your money in the plan if you leave. It says you can, and you get 5.5% annual interest, and you keep your service credit. You can roll it into an IRA or other eligible retirement plans. So, yeah, you can. And when are we supposed to be out? Because I'm so confused about the snow. Like right now, right?
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?